India didn't just announce a budget, it quietly rewrote the future. Trillions shifted, risks were taken, and one decision could decide growth or crisis. While headlines chased tax relief, something far bigger moved beneath the numbers. Infrastructure surged, debt tightened, states watched closely, and markets held their breath. This budget isn't about money. It's about power, priorities, and what India chooses to become next. The stakes have never been higher. For everyone watching closely, start with the scoreboard. Total expenditure jumps to a massive 53.47 lakh rupees crore. That figure isn't spending, it's a blueprint showing what gets built, protected, or postponed for the next year. Capital expenditure is the engine. 12.21 lakh rupees crore for roads, rail, ports, and cities. When Capex rises, contractors hire, factories run, and confidence follows into every district, village, and market. But look deeper. Effective Capex hits 17.14 lakh rupees crore because grants also create assets. It's the hidden multiplier, turning transfers into bridges, pipes, and stations that outlive political headlines today. Every budget has a pressure gauge, fiscal deficit. This year targets 4.3% of GDP, borrowing to fund growth, while trying not to overheat inflation or debt in a world of shocks outside. Revenue deficit falls near 1.5% of GDP, meaning daily bills are closer to covered by revenue. That frees space for long-term projects without drowning in interest as rates swing globally. Interest payments alone cross 14 lakh rupees crore. Think of it as rent on past decisions. The higher it climbs, the less room remains for new dreams and less growth outruns costs. On the income side, net tax revenue to the center is about 28.67 lakh rupees crore. That stream depends on growth, compliance, and how fast the economy breathes under pressure today. Non-tax revenue adds roughly 6.66 lakh rupees crore from dividends, fees, and interest receipts. It's quieter money, but it cushions the budget when taxes underperform or when growth slows suddenly down. Then comes the federal drama. States' share of divisible taxes stays at 41%. For chief ministers, that percentage is oxygen, funding schools, hospitals, and local infrastructure without waiting for approvals forever. Finance Commission grants near 1.4 lakh rupees crore add another layer, targeted to specific needs. Grants can reward reforms, protect ecosystems, or stabilize weaker states so national growth doesn't fracture apart. The entire math rests on one assumption: nominal GDP growth around 10%. If growth surprises downward, deficits widen. If it accelerates, the same numbers feel lighter, like gravity changing mid-flight. Gross borrowing is even larger, near 17.2 lakh rupees crore, because old debt must be rolled over. It's refinancing on a national scale, with timing critical when global rates turn hostile. That's why the Infrastructure Risk Guarantee Fund matters. It promises partial protection for viable projects, lowering lenders' fear and pulling private capital into roads, metros, and utilities at scale faster. Cities get a new lens. City economic regions, funded through a challenge mode with 5,000 crore rupees over 5 years. The goal is productivity, better commuting, land use, and logistics for growth. Agriculture allocation rises to about 1.63 lakh rupees crore, with emphasis on high-value crops and allied income. The bet: farmers earn more per acre, not just more grain in changing climates. Railways and logistics are the silent accelerators. Faster freight corridors reduce travel time for goods, lowering inventory costs. When logistics improves, exports rise, and inflation pressure eases without flashy announcements. Customs tweaks support energy transition, incentives for lithium-ion manufacturing, solar inputs, and critical mineral processing. Behind the scenes, this is about supply security, not just green slogans in geopolitics now. Even nuclear projects get longer duty exemptions, stretching to 2035. That signals patience. Big energy infrastructure takes decades, and policy stability is the real fuel for investors watching from afar. A small line carries big intent. Blended bio-CNG gets clearer valuation rules. It nudges cleaner transport fuels, and it helps new plants predict cash flows before banks commit serious money today. Direct taxes shift structurally. A new Income Tax Act framework is slated to take effect from April 2026. The promise is simpler language and fewer disputes, so compliance feels less scary. The finance bill also introduces a disclosure window for small taxpayers' foreign assets. It's a pressure release valve, encouraging honesty now, before enforcement gets sharper later while bringing money into the system. Notably, there's no dramatic income tax slab surprise. The story here isn't instant relief. It's long-term capacity, building assets, attracting capital, and managing risks so growth can pay for tomorrow's promises too. Markets read budgets between lines. Stable slabs, high capex, and controlled deficits signal continuity. That steadiness calms investors, supports equities, anchors bonds, and shapes foreign capital decisions quietly over months. Inflation fears linger globally, but supply-side focus matters. Better logistics, energy inputs, and productivity can cool prices without crushing demand, giving central banks breathing room while growth stays alive nationwide. For households, the impact is indirect. Jobs follow construction cycles, EMIs follow bond yields, and prices follow supply. Budget effects arrive slowly, then suddenly, across kitchens, wallets, and aspirations nationwide. Small businesses watch credit conditions closely. Guarantees reduce lender fear. Capex creates orders, and predictable policy lowers risk premiums, letting entrepreneurs plan expansions instead of surviving quarter-to-quarter cycles. States calculate differently. Transfers fund essentials, but performance-linked grants reward reforms. Efficient states sprint ahead. Laggards face pressure to modernize systems, digitize delivery, and stretch every rupee further this year. Debt to GDP near 55% frames every choice. Borrow too fast, credibility cracks. Borrow too little, growth stalls. The balance defines India's negotiating power with markets and rating agencies alike globally. Global context matters more than ever. Wars, elections, supply shocks, and rate cycles shape capital flows. This budget positions India as steady terrain when volatility scares money elsewhere across markets. Energy security threads through multiple announcements. From solar inputs to nuclear timelines, policy favors long horizons, reducing import dependence and shielding growth from external price spikes and geopolitical leverage risks. Manufacturing benefits quietly. Duty exemptions, logistics upgrades, and scale incentives cut costs. Over time, that compounds into competitiveness, exports, and jobs without a single headline-grabbing factory announcement for global markets. Financial markets parse credibility signals. Meeting deficit targets builds trust, lowering yields. Miss them, and borrowing costs climb, shrinking fiscal space faster than any spreadsheet projection warns on paper alone. Technology underpins execution. Digitized payments, monitoring dashboards, and data-linked grants reduce leakage. When implementation improves, the same rupee delivers more schools, roads, and services than before across regions and sectors. Sustainability runs beneath the surface. Climate-resilient agriculture, cleaner fuels, and efficient transport reduce future costs. Ignoring climate risk would quietly sabotage every growth assumption baked into projections over coming decades. There are trade-offs. High capex limits short-term giveaways. Tax restraint tests patience. But the strategy bets voters value durable assets more than temporary relief when narratives fade from public memory. Critics question execution capacity. Announcements don't pour concrete. Success depends on tendering speed, state coordination, and project management discipline across thousands of works running simultaneously nationwide without delays, disputes, overruns. Ultimately, this budget is a signal. It tells investors, states, and citizens that India prioritizes building capacity now, accepting measured risk today to shape resilience tomorrow in an uncertain world. Zoom into timelines. Infrastructure spending peaks only after approvals, land clearance, and financing align. Delays today shift benefits years ahead, testing political patience while economic logic quietly waits to mature. Urban infrastructure absorbs a major share. Metros, water systems, and housing upgrades raise productivity invisibly by saving time, reducing illness, and lowering friction in daily life for millions of commuters. Rural spending works differently. Roads, irrigation, and storage reduce losses and volatility. These investments don't trend online, but they stabilize incomes, migration patterns, and food prices over long cycles. Education and skilling benefit indirectly. Construction booms create demand for engineers, technicians, welders, and planners, skills that outlast projects and lift workforce resilience beyond single sectors nationwide. Health outcomes follow infrastructure. Clean water, sanitation, and transport access reduce disease burden cheaply. These savings never appear as revenue, yet they free household income and productivity silently over time. Private capital watches consistency. One stable budget matters less than many predictable ones. Sudden reversals scare investors more than tough numbers, making policy credibility the rarest, most valuable national asset. Rating agencies dissect trajectories, not speeches. Debt paths, revenue realism, and reform follow through shape outlooks that affect borrowing costs long after applause fades inside parliament halls. Currency stability links back to confidence. Lower deficits and steady growth reduce pressure on the rupee, protecting import costs for energy, electronics, and fertilizers critical to households and farms alike. Export competitiveness improves when logistics cheapen. Faster ports and corridors compress delivery times, making Indian goods reliable. Reliability often matters more than price in global supply contracts today. Digital public infrastructure quietly supports execution. Real-time tracking of payments and milestones exposes delays early, turning governance into a data problem rather than a political shouting match. Transparency helps trust. Clear numbers, realistic assumptions, and published trajectories reduce surprises. Markets fear shocks more than bad news when it arrives early and honestly framed. Infrastructure also reshapes geography. Regions once isolated integrate into supply chains, altering migration, land values, and political priorities as connectivity rewires economic maps gradually but permanently. Over time, better connectivity compresses inequality gaps. Opportunity travels faster than people, reducing forced migration and balancing regional growth without heavy subsidies or perpetual transfers. Still, risks remain. Cost overruns, legal disputes, and land conflicts can stall momentum. Governance quality determines whether ambitious budgets translate into durable outcomes or frustrating delays. For youth, the impact arrives through work. Construction, logistics, manufacturing, and planning absorb skills quickly, translating abstract numbers into livelihoods that anchor optimism during uncertain global employment cycles. Women benefit indirectly from infrastructure. Better transport, water access, and energy reduce unpaid labor burdens, freeing time for education, entrepreneurship, and formal work participation over time. Urban housing upgrades stabilize labor markets. When workers live closer to jobs, productivity rises, absenteeism falls, and cities grow more efficiently without endless sprawl or congestion penalties. Water infrastructure quietly underpins everything. Reliable supply supports health, industry, and agriculture, preventing crises that force emergency spending far costlier than planned investments ever were. Transport efficiency compresses inflation volatility. When goods move smoothly, shocks absorb faster, protecting consumers from sudden spikes driven by bottlenecks rather than real scarcity. Over the long arc, budgets shape behavior. Businesses invest, households plan, and states reform based on perceived stability, not one-time incentives or short-lived political theater. India's demographic window amplifies stakes. Missed investment today wastes youthful energy. Timely infrastructure converts population scale into productivity before aging pressures emerge later. External investors judge consistency across cycles. Repeating Capex focus year after year builds credibility that one-off stimulus never achieves in global capital markets. Fiscal discipline also protects policy freedom. Lower deficits mean flexibility during crises, allowing stimulus when needed instead of panic borrowing under hostile conditions. Technology-driven governance reduces corruption risks. Automated payments and audits shrink discretion, turning integrity into a system feature rather than a personality trait. As assets accumulate, maintenance matters. Ignoring upkeep destroys value faster than slow building, forcing future budgets to repair rather than expand capacity. Public perception lags reality. Benefits surface years later, while costs appear immediately. Managing expectations becomes as vital as engineering execution in sustaining political consensus. Global comparisons matter. Competing economies also invest heavily. Standing still means falling behind, making infrastructure momentum a strategic necessity, not optional policy preference. The budget's real test arrives during shocks. Recessions, conflicts, or climate events will stress assumptions, revealing whether resilience was truly built or merely promised. Mid-course corrections remain possible. Data-driven reviews allow reallocation, ensuring funds chase impact rather than sunk costs when priorities shift unexpectedly. Transparency with citizens sustains trust. Clear communication on progress, delays, and trade-offs prevents rumor-driven panic that can derail sound long-term strategies. Over years, infrastructure shapes culture. Mobility changes lifestyles, connectivity alters aspirations, and access redefines what citizens expect from governance and opportunity. Budget numbers fade, but assets remain. Roads, grids, and institutions outlast political terms, quietly compounding value long after debates move on. Future policymakers inherit today's choices. Responsible budgeting expands options. Reckless spending narrows them, transferring pain rather than progress to the next generation. Economic narratives shape confidence. This budget frames India as builder, not spender, prioritizing capacity over consumption to strengthen foundations before pursuing broader welfare ambitions. The risk is impatience. Results demand time, and abandoning strategy midway wastes sunk costs. Consistency becomes the quiet hero of national development stories. Economic resilience isn't loud. It's built through redundancy, buffers, and boring discipline. Budgets that look dull often perform best when crises test every assumption brutally. This budget trades spectacle for substance. Its success depends less on applause and more on spreadsheets, site visits, and sustained follow-through across thousands of unglamorous decisions. Long-term growth stories are written quietly. They emerge from aligned incentives, patient capital, and institutions learning from mistakes rather than denying them. India's fiscal path now aims for credibility, resilience, and momentum together. Achieving all three simultaneously is difficult, but abandoning any one risks undermining the others. The numbers invite scrutiny, not blind faith. Healthy debate sharpens outcomes, ensuring budgets evolve through evidence rather than ideology alone. Ultimately, budgets reflect priorities. This one prioritizes building capacity before distributing rewards, betting that strong foundations enable fairer outcomes later. As the year unfolds, reality will answer projections. Progress will be uneven, lessons learned, and adjustments made as numbers confront the real world. Success won't arrive as one moment. It accumulates through milestones reached, delays fixed, and systems improved beyond headlines and political cycles. Failures will teach too. Identifying what didn't work protects future budgets from repeating expensive mistakes hidden behind optimistic assumptions. In that sense, this budget is less an event and more a process, one that unfolds over years through disciplined execution and constant recalibration. India's trajectory depends on staying the course. Consistent investment, realistic accounting, and institutional strength determine whether ambition converts into durable national capability. This budget sets conditions, not guarantees. Outcomes hinge on coordination, competence, and courage to correct errors without abandoning the broader vision. Years from now, analysts will trace outcomes back here. They'll ask whether this was the moment India chose patience over populism under global uncertainty. Budgets don't build nations alone. People, institutions, and execution do. But budgets decide whether those forces move together or pull apart under pressure. And that is the real story hidden inside these numbers, not what was promised, but whether discipline, patience, and execution can turn ambition into lasting national strength. 1 year from now, these numbers won't be headlines. They'll be highways, jobs, prices, and choices you feel every day. Some promises will rise like steel. Others will vanish like smoke. The real budget isn't printed on paper. It's written in execution, resilience, and what we demand from our future. If you tracked this story to the end, keep watching the next quarterly signals, because the biggest reveal hasn't happened yet. What will they really show next?